Every single day, trillions of dollars flow through the global financial system, invisible, silent, and completely unnoticed by 99% of the population. When you open your banking application, you see a balance. When you buy a share of stock, you see a transaction. You assume this is how money works. You believe that the money you deposit in a commercial bank sits in a digital vault, waiting for you, but you are wrong. Underneath the visible economy of credit cards, real estate, and stock markets lies a deep, dark financial ocean. It is the plumbing of global capitalism. It is a market that does not deal in cash, but in the immediate exchange of collateral. It is called the repurchase agreement market, or simply, the repo market. If this market stops breathing for even a single day, the entire global financial architecture collapses. ATM machines stop dispensing cash. Supermarkets run out of food within 72 hours. The largest corporations on Earth default on their payrolls. And yet, almost no one knows it exists. To understand how this invisible ocean controls your world, let's contrast two entirely different players in the financial system. Meet Daniel. Daniel is the conservative chief financial officer of a mid-sized logistics firm. He manages $50 million in corporate cash. Daniel believes in safety. He places his company money into traditional commercial bank deposits and short-term treasury bills. To Daniel, a dollar is a dollar, and liquidity means having cash in a checking account. Now meet Victor. Victor is a managing director at a $70 billion hedge fund in New York. Victor operates in a completely different dimension. To Victor, holding cash is a failure. Cash is dead. Cash loses value to inflation every second. Instead, Victor uses a sophisticated, hyper-leveraged structure. He holds billions of dollars in highly liquid government debt, United States Treasury bonds. When Victor needs $50 million to fund a high-speed algorithmic trade, he does not withdraw it from a bank. He does not ask for a loan. Instead, Victor uses the repo market. He takes $50 million worth of his treasury bonds, hands them to an institutional lender, and receives $49,500,000 in cash, promising to buy those bonds back the very next morning for $49,550,000. In less than 12 hours, Victor has generated massive liquidity without selling a single asset. Daniel operates in the slow, visible economy of commercial banking. Victor operates in the fast, invisible economy of shadow banking. What Victor just executed is a repurchase agreement. On the surface, it looks like a sale and a repurchase. But in reality, it is a secured overnight loan. The government bond is the collateral. The difference between the sale price and the repurchase price is the interest rate, known as the repo rate. In our financial system, government debt has evolved. It is no longer just an investment that pays interest. In the shadow banking system, government debt is money. It is the ultimate collateral. It is cleaner than cash, more secure than cash, and accepted by every financial institution on Earth. To comprehend why this system exists, we must first look at the structural limitations of traditional banking. When Daniel deposits $50 million into a standard commercial bank, he thinks his money is completely safe. But it is not. In the United States, the Federal Deposit Insurance Corporation only guarantees deposits up to $250,000. If Daniel's bank goes bankrupt, $49,750,000 of his corporate cash could vanish forever. For major corporations, sovereign wealth funds, and massive hedge funds, traditional banks are actually highly risky places to store money. They need a system where they can store billions of dollars without taking on bank default risk. This is where the repo market steps in. By using a repurchase agreement, Victor does not have to trust a bank. If Victor lends $50 million in cash to an investment bank overnight in exchange for $50 million in treasury bonds, his risk is virtually zero. If the investment bank goes bankrupt at 3 o'clock in the morning, Victor does not have to wait for a government bailout. He simply keeps the treasury bonds and sells them on the open market to recover his $50 million. The collateral eliminates the need for trust. This is the first core mechanism of the shadow banking system, collateralized lending. But the system is far more complex than a simple one-to-one transaction. Let us look at the mathematics of the haircut. When Victor hands $50 million of treasury bonds to a lender, the lender does not give him $50 million in cash. They apply a haircut. If the haircut is 1%, the lender only gives Victor $49,500,000. This 1% buffer protects the lender against the risk that the value of the treasury bonds might drop overnight. The size of the haircut is a direct reflection of risk in the financial system. In calm economic times, the haircut on United States Treasuries might be as low as 0.5%. But in times of extreme financial panic, haircuts can skyrocket. If the haircut rises to 10% or 20%, the amount of cash Victor can borrow against his assets plummets. This is how liquidity evaporates in an instant. Now, let us examine the concept of rehypothecation. This is the ultimate multiplier of the shadow banking system. When Victor hands his treasury bonds to the lender does not just put them in a digital vault. In many cases, the contract allows the lender to use those exact same treasury bonds as collateral for their own transactions. The lender might take Victor's bonds and use them in another repo transaction to borrow cash from a third party. That third party might then use the same bonds to secure a loan from a fourth party. This chain can go on, 5, 6, or 7 times. This means that a single $1 million treasury bond can back $5 million, $6 million, or $7 million of credit flowing through the global economy. The entire financial system becomes a towering stack of cards, all resting on a single piece of collateral. This cascading risk is highly efficient during economic growth, but incredibly fragile when collateral drops in value, sparking margin calls that crash global financial markets. To see this fragility in action, we only have to look back to the autumn of 2019, long before the global economy faced a biological pandemic. During the middle of September, the plumbing of the global financial system suddenly froze. Without warning, the overnight repo rate, which usually hovered around 2%, exploded to nearly 10%. For a hedge fund like Victor's, this was a code red emergency. When the repo rate spikes to 10%, the cost of borrowing cash overnight to maintain highly leveraged positions increases 5-fold. For a firm holding billions in debt, that extra 8% is not a minor expense. It is a financial death sentence. Daniel, sitting in his office at the logistics firm, looked at the financial news on his terminal. He read headlines about the Federal Reserve injecting $75 billion of cash into the repo market. To Daniel, this sounded like dry, academic jargon. His $50 million was safe in his commercial bank account, earning its predictable, conservative yield. He did not understand why the central bank was printing billions of dollars to buy government debt from Wall Street institutions. But Victor, operating on the institutional front lines, was in a state of absolute panic. Victor's hedge fund utilized a highly aggressive strategy known as basis trading. They would buy United States Treasury bonds and simultaneously sell Treasury futures contracts, exploiting tiny price discrepancies between the two markets to extract minuscule but predictable profits. Because the profit margins on these trades are microscopic, Victor had to scale up. He used the repo market to leverage his positions 50-1. For every $1 million of his fund's actual capital, Victor was borrowing $49 million overnight from institutional lenders. As long as the overnight repo rate remained stable at 2%, the trade was highly profitable. But when the rate spiked to 10%, the math broke. Suddenly, Victor was losing millions of dollars every hour. If he could not find cheap cash to roll over his loans by 5 o'clock in the afternoon, his lenders would execute their rights under the repurchase agreements. They would seize his billions of dollars in treasury bonds and sell them into the open market. This would trigger a massive sell-off, driving the price of government debt down, which would force other hedge funds to face margin calls, causing a systemic chain reaction. This is the definition of a run on the shadow banking system. Why did this happen? It was not because of a bad housing market or a massive corporate fraud. It was a pure liquidity mismatch, a drought in the financial plumbing. The corporate tax payment deadline was approaching, meaning companies like Daniel's logistics firm were withdrawing cash from commercial banks to pay the government. Simultaneously, the United States Treasury was issuing a massive amount of new debt, which primary dealer banks were forced to purchase. The banks had to use their cash reserves to buy these new bonds, leaving them with very little excess cash to lend in the repo market. The demand for overnight cash skyrocketed while the supply of cash collapsed. This historical event exposes the critical vulnerability of modern finance. Commercial banks no longer operate merely as places that take in deposits and make loans. Instead, they operate as dealers of liquidity. And in this market, there are two distinct ways these transactions are structured: bilateral repos and tri-party repos. In a bilateral repo, Victor's hedge fund deals directly with an institutional lender, such as a major investment bank. They negotiate the terms, the haircut, and the repo rate directly. Once agreed, Victor transfers his treasury bonds to the investment bank, and the investment bank transfers cash to Victor. This structure gives both parties maximum flexibility, but it requires them to manage the operational risk themselves. They must handle the daily valuation of the collateral, margin calls, and the physical settlement of the transaction. For massive institutions dealing in hundreds of millions of dollars, this operational burden is immense. To solve this efficiency problem, the financial elite created the tri-party repo market. In a tri-party repo structure, Victor and his lender do not interact directly when settling the transaction. Instead, they use a neutral third party, a clearing bank. In the United States, this role is dominated by a single, systemic institution, Bank of New York Mellon. The clearing bank acts as the custodian for both cash and collateral. When Victor and his lender agree to an overnight repo, they both send their assets to the clearing bank. The clearing bank's sophisticated automated systems handle the rest. They verify that the collateral meets the lender's risk criteria, calculate the appropriate haircut, transfer the cash, and return the assets the next morning. This centralization makes the system incredibly efficient, allowing trillions of dollars to move seamlessly with the click of a button. But this efficiency comes with a dangerous trade-off: extreme concentration of systemic risk. Because almost the entire tri-party repo market flows through a single clearing bank, any operational failure, computer glitch, or financial distress at that bank would instantly freeze the plumbing of the global financial system. If Bank of New York Mellon's systems go offline for even 12 hours, trillions of dollars in overnight transactions cannot settle. Hedge funds cannot roll over their debt, investment banks cannot fund their daily operations, and the global credit market grinds to a complete halt. To prevent such a catastrophic collapse, the Federal Reserve had to step in and become the ultimate backstop of this system. They did this by creating a highly powerful and controversial tool, the Overnight Reverse Repurchase Agreement Facility. Known in Wall Street circles as the RRP, this facility allows non-bank financial institutions, such as money market funds, to bypass commercial banks entirely and lend their excess cash directly to the central bank overnight. In exchange, the Federal Reserve provides them with treasury bonds from its massive balance sheet, paying them a guaranteed interest rate. By locking up trillions of dollars in pristine government collateral inside its own vaults to facilitate these transactions, the Federal Reserve inadvertently starves the private banking sector of the very bonds it needs to survive, creating an artificial shortage. This structural deficit forces desperate institutional players to construct even more dangerous financial alternatives, shifting the risk away from traditional government debt and into the unregulated shadows of the private asset-backed securitization market, where the next great financial firestorm is quietly beginning to burn. This transition from pristine government debt to lower-quality assets is driven by one simple reality: a desperate shortage of high-quality collateral. In the shadow banking system, there are not enough United States Treasury bonds to satisfy the insatiable demand for overnight borrowing. When Victor's hedge fund and other massive institutional players want to scale up their leverage bets, they run into a physical wall. They have the appetite to borrow trillions of dollars, but they do not have the high-quality collateral required by risk-averse lenders. This imbalance gave birth to a highly lucrative, highly complex practice known as collateral transformation. To understand how collateral transformation works, let us look at how Victor solves his asset bottleneck. Victor's hedge fund owns billions of dollars in lower-grade assets, such as high-yield corporate bonds, commercial real estate loans, and mortgage-backed securities. These assets are illiquid. Institutional lenders in the tri-party repo market will not accept them as collateral. If Victor offers corporate junk bonds to a major conservative money market fund, they will reject him instantly. They demand pristine, AAA-rated government debt. So, Victor goes to a large institutional player that holds massive portfolios of unused treasuries, but is looking to squeeze out a slightly higher yield, such as a state pension fund or a major life insurance company. Let us call this entity the long-term investor. Victor proposes a swap. He hands his lower-grade, high-yield corporate bonds to the pension fund. In exchange, the pension fund hands their pristine United States Treasury bonds to Victor. Victor pays the pension fund a small, predetermined fee, usually a few basis points, for the privilege of the swap. This transaction is the essence of collateral transformation. For the pension fund, they have taken their safe, borrowing treasury bonds, and leased them out to earn an extra stream of income, holding Victor's corporate bonds as protection. For Victor, the magic has occurred. He has transformed his illiquid, undesirable junk collateral into pristine, highly acceptable government collateral overnight. He takes those newly acquired treasuries, marches into the tri-party repo market, and uses them to borrow $49 million in cash to fund his high-speed algorithmic trades. Back in his logistics office, Daniel has no idea that his own employee's pension fund is actively participating in this parallel universe. Daniel assumes the company's retirement assets are locked safely in a conservative custody account. He does not realize that the pension managers are actively leasing out those safe treasury bonds to aggressive hedge funds like Victor's, taking on the hidden counterparty risk of lower-grade corporate debt just to beat their benchmark return by a fraction of a percent. This is how systemic risk quietly migrates from the aggressive edges of Wall Street directly into the retirement accounts of everyday citizens. But collateral transformation is only one symptom of a much larger structural shift in global finance: the death of deposit funding and the rise of wholesale funding. In the middle of the 20th century, commercial banks operated under a simple model. They gathered deposits from retail customers like Daniel, paid them a modest interest rate, and used those deposits to fund long-term loans to local businesses and homebuyers. The system was slow, localized, and highly regulated. Today, the world's largest financial institutions do not rely on retail deposits to fund their operations. The scale of modern finance is simply too massive. A global investment bank with a $2 trillion balance sheet cannot fund itself with $20 checking accounts. Instead, they rely on wholesale funding, a massive, centralized market where institutional giants lend and borrow billions of dollars from each other on a daily, overnight basis. The primary instrument of this wholesale funding market is, of course, the repurchase agreement. In this wholesale ecosystem, the traditional concept of a bank has been completely redefined. We must look at the rise of the broker-dealer. Unlike traditional commercial banks, broker-dealers do not have a stable base of retail depositors. They do not have branches on street corners. Instead, they operate as market makers, investment banks, and security dealers. Their entire balance sheet is funded almost entirely through overnight repo borrowing. Every single morning, a major broker-dealer must borrow tens of billions of dollars in the wholesale market just to keep its doors open. Every single afternoon, they must repay those loans, only to start the exact same cycle again the following morning. This creates a terrifying reality. Traditional commercial banks are protected from sudden bank runs by two critical safety nets: Federal Deposit Insurance Corporation insurance and the Federal Reserve's discount window, which allows them to borrow emergency funds directly from the government. But shadow banks and broker-dealers do not have access to these safety nets. If institutional lenders in the repo market suddenly decide that a broker-dealer's collateral is too risky, or if they grow concerned about the dealer's solvency, they do not queue up outside a physical bank branch to withdraw their money. Instead, they simply refuse to roll over their overnight repo loans. They pull their cash back instantly, refusing to accept the broker-dealer's collateral. When this happens, the shadow bank does not fail over a period of weeks or months. It collapses in a matter of hours. This is exactly what happened to Bear Stearns and Lehman Brothers in 2008. Their collapses were not triggered by a slow decline in their mortgage portfolios. They were triggered by a sudden, violent run in the overnight repo market. One day, institutional lenders decided they no longer trusted the mortgage-backed securities being offered as collateral. They demanded higher haircuts, and then they stopped lending altogether. Without overnight wholesale funding, these multi-billion-dollar institutions ran out of cash before the market closed, triggering a global financial cardiac arrest. To prevent another total systemic freeze, the Federal Reserve was forced to implement a radical new monetary policy known as quantitative easing. Under this program, the central bank created trillions of dollars of new digital currency out of thin air, using that cash to buy massive quantities of government bonds and mortgage-backed securities directly from the primary dealers. While the public was told this printing of money was designed to stimulate lending to everyday consumers like Daniel, the hidden reality was far more cynical. It was a massive and permanent liquidity injection designed to replace the collapsed private wholesale repo market and keep the fragile shadow banking system permanently on life support. This permanent life support system created a profound structural paradox that few economists fully understand. When the Federal Reserve buys trillions of dollars in government bonds to flood commercial banks with digital reserves, it is simultaneously removing those very bonds from the open market. By locking these treasuries away on its own balance sheet, the central bank reduces the supply of high-quality collateral available for private repurchase agreements. This means that while commercial banks have massive cash reserves, hedge funds like Victor's find it increasingly difficult to locate the physical bonds needed to secure their overnight loans. The market is drowning in cash, yet starving for collateral. To resolve this paradox, the financial system expanded its footprint beyond domestic borders, tapping into a vast, unregulated global pool of dollar credit, known as the Eurodollar market. To understand how this offshore ocean dictates global wealth, we must look at how international trade is actually settled. When Daniel's logistics firm coordinates a shipping contract between a manufacturer in Tokyo and a distributor in Frankfurt, the transaction is not settled in Japanese yen or European euros. It is settled in United States dollars. The dollar is the global reserve currency, meaning it is the medium of exchange for over 80% of international trade. But the banks facilitating this Tokyo to Frankfurt trade are not located in New York or Chicago. They are foreign banks, operating completely outside the jurisdiction of the United States government. This is where the Eurodollar comes into play. A Eurodollar is simply any United States dollar-denominated deposit held in a commercial bank outside of the United States. These deposits are not backed by the Federal Deposit Insurance Corporation. These deposits are not subject to the reserve requirements of the Federal Reserve. They exist in a parallel, completely unregulated offshore banking network that spans London, Tokyo, Singapore, and Zurich. This offshore market is gigantic, estimated to be worth tens of trillions of dollars, dwarfing the domestic United States money supply. Because these foreign banks do not have a stable base of domestic American retail depositors, they cannot fund their daily dollar liabilities through standard checking accounts. Instead, they rely almost entirely on the offshore wholesale market. They borrow dollars overnight from other foreign institutions, sovereign wealth funds, and multinational corporations. And the primary machine they use to secure these overnight dollar loans is, once again, the repo market. For a foreign bank, obtaining overnight dollars is a matter of corporate survival. If a European bank has promised to pay $10 million to a Japanese client at 9 o'clock in the morning, and they do not have those dollars on hand, they cannot simply call the Federal Reserve for an emergency loan. They do not have access to the Federal Reserve's domestic discount window. Instead, they must go into the offshore repo market. They take the United States Treasury bonds they hold in their investment portfolios, hand them to a lender in London, and borrow the $10 million overnight. The next morning, they repay the loan plus interest, retrieve their treasuries, and repeat the cycle. But what happens if a global crisis strikes and foreign lenders suddenly refuse to accept those treasury bonds, or if the supply of offshore dollars dries up? This is the ultimate nightmare scenario for the global economy. In a domestic banking crisis, the Federal Reserve can print money to bail out American banks. But in an offshore Eurodollar crisis, the Federal Reserve has no direct jurisdiction over foreign institutions. It cannot directly bail out a bank in Frankfurt or Tokyo. This creates a massive dollar shortage, where foreign banks are desperately scrambling to buy dollars to pay off their overnight debts, driving the value of the dollar up and causing global credit markets to freeze. This is the hidden pipeline through which domestic monetary policy impacts the entire planet. When the Federal Reserve raises interest rates in Washington, it is not just making credit cards more expensive for domestic consumers. It is increasing the borrowing costs for foreign banks in the Eurodollar market. If the cost of overnight dollar funding rises, foreign banks are forced to reduce their lending to international businesses. A shipping company in Singapore cannot finance its cargo, a construction firm in Brazil cannot fund its infrastructure project, and a manufacturer in Germany is forced to downsize. The global economy slows down, not because of local economic conditions, but because the offshore dollar plumbing has contracted. Back in his logistics office, Daniel notices the ripple effects of this contraction without ever realizing its source. He complains to his team that the cost of shipping containers from Asia has spiked, and that their international clients are taking longer to pay their invoices. Daniel attributes these delays to supply chain inefficiencies or geopolitical tensions. He has no idea that the real culprit is a hidden dollar liquidity squeeze in the London repo market, where the European banks facilitating his trade are struggling to secure overnight collateral. Daniel's business is intimately connected to this offshore financial web, yet its mechanics remain completely invisible to him. To combat these global dollar shortages, the Federal Reserve was forced to expand its role as the lender of last resort to the entire world. They did this by establishing a highly powerful, semi-permanent mechanism known as central bank liquidity swap lines. Under these agreements, the Federal Reserve swaps physical United States dollars with foreign central banks, such as the European Central Bank or the Bank of Japan, in exchange for their local currencies. The foreign central banks then lend those dollars directly to their local commercial banks through their own domestic repo operations. This mechanism allows the Federal Reserve to bypass its legal boundaries and inject dollar liquidity directly into the offshore Eurodollar market. In essence, the Federal Reserve has become the global central bank, printing dollars to support the entire international financial architecture. But this global backstop is not a permanent solution. It is a massive patch on a fundamentally unstable system, where the sheer volume of offshore dollar liabilities completely dwarfs the central bank's ability to intervene. The entire global economy is now locked in a precarious balancing act, resting on a mountain of offshore debt that is completely reliant on the daily, uninterrupted flow of overnight collateral. To escape this sovereign bottleneck, elite financial institutions began manufacturing synthetic collateral, bypassing the United States Treasury completely by creating private label debt products that trade in a shadow market where the ultimate, hidden wealth mechanics of the global elite are finally laid bare. This shadow market of synthetic collateral represents the absolute peak of modern financial engineering. When investment banks can no longer find enough physical government bonds to satisfy the demands of the repo market, they do not stop trading. Instead, they manufacture their own bonds. They take thousands of risky, low-grade private debts, such as subprime auto loans, credit card balances, and commercial mortgages, and bundle them together into a single pool. This process is known as securitization. Through the mathematical wizardry of credit enhancement, they structure these pools into different risk layers or tranches. The highest layer, the senior tranche, is legally structured to absorb losses last. Because of this structural protection, rating agencies grant this senior tranche a pristine, AAA rating, making it look just as safe as a United States Treasury bond. This is how high-yield, subprime debt is chemically transformed into pristine synthetic collateral. A foreign bank or a money market fund that would never dream of lending cash against a pool of delinquent car loans will happily accept this AAA-rated senior tranche in a tri-party repo agreement. The shadow banking system has successfully manufactured its own money, completely bypassing the sovereign constraints of the state. For Victor, this synthetic collateral market is an absolute goldmine. His hedge fund does not just trade treasuries. They actively purchase the junior, high-risk tranches of these securitized debt pools. These junior tranches pay massive interest rates because they are the first to absorb losses if borrowers default. Victor then uses his synthetic alchemy to leverage these positions. He takes his high-risk junior tranches, swaps them for AAA-rated synthetic tranches through collateral transformation agreements, and uses those pristine tranches in the repo market to borrow billions of dollars in cheap overnight cash. He reinvests that cash into even more high-yield debt, compounding his wealth at a geometric rate. Victor is playing a high-stakes game where he extracts billions in profits during the boom years, knowing that if the system collapses, the Federal Reserve will be forced to bail out the entire repo market to prevent a global credit freeze. Meanwhile, Daniel's logistics firm remains completely vulnerable to the hidden volatility of this synthetic engine. When Daniel deposits his company's $50 million in corporate cash into his traditional commercial bank, he believes he is supporting a local business ecosystem. He assumes his bank is using those deposits to fund stable, productive loans to real companies. But the bank's Treasury Department operates in the same wholesale funding market as Victor. To maximize their profit margins, the bank takes Daniel's deposits and lends them overnight in the tri-party repo market, accepting Victor's synthetic, AAA-rated tranches as collateral. Daniel's safe, boring corporate cash is actively funding the hyper-leveraged bets of Wall Street hedge funds. If those synthetic tranches suddenly default, Daniel's bank faces insolvency, and his $50 million is placed on the chopping block. This is the ultimate, terrifying synthesis of the modern monetary system. The line between traditional, regulated banking and the unregulated shadow banking system has been completely erased. Daniel believes he is outside of this machine, but he is actually its primary fuel source. Victor knows he is inside the machine, and he manipulates its plumbing to extract generational wealth, leaving the taxpayer to shoulder the ultimate systemic downside. Every single financial transaction, from a local checking deposit to an international shipping invoice, is ultimately processed through this massive, invisible overnight repo network. We must realize that the repurchase agreement market is not a small, isolated corner of Wall Street. It is the actual heart of the global financial system. It is the silent, mechanical pump that keeps credit flowing through every vein of the world economy. It determines the price of your mortgage, the cost of your groceries, the stability of your pension, and the strength of your national currency. It is a system built entirely on the fragile illusion of liquidity, an illusion that requires trillions of dollars in pristine collateral to exchange hands every single day without a single operational glitch. If the collateral runs dry, or if trust between institutional lenders evaporates for even 12 hours, the pump freezes. And when the pump freezes, the entire global economy begins to die. The financial elite have constructed a towering monument of debt, supported by a hyper-complex web of rehypothecated bonds, collateral transformations, and offshore Eurodollars. It is an architecture of unimaginable efficiency, but of extreme, catastrophic fragility. As we look to the future, the central banks of the world continue to print trillions of dollars to keep this plumbing from freezing, but they are fighting a losing battle against the sheer scale of private credit expansion. The invisible ocean of shadow banking continues to rise, and beneath its calm, digital surface, the next great liquidity crisis is already quietly gathering strength. This gathering storm is further intensified by the regulatory architecture designed to prevent it. In the wake of previous financial panics, global regulators implemented highly complex capital requirements, such as the Basel III Accord. These rules were intended to make commercial banks safer by forcing them to hold higher levels of liquid assets, primarily government debt. But this regulatory push has had a massive, unintended consequence. By forcing every commercial bank on earth to lock up trillions of dollars in pristine treasury bonds on their balance sheets, regulators have inadvertently worsened the collateral shortage in the private repo market. Unable to locate physical bonds, the shadow banking system is forced to rely even more heavily on synthetic replication and collateral transformation swaps. The very rules designed to make Daniel's traditional bank safe are forcing Victor's shadow bank to build a larger, more fragile tower of private label debt, pushing systemic risk deeper into the bilateral darkness where regulators cannot see. Ultimately, the hidden plumbing of global wealth operates on a fundamental truth that both Daniel and Victor must eventually confront. Money is no longer what we think it is. It is not cash in a vault, nor is it a number on a screen. In the modern era, money is trust, and trust is structured entirely through collateral. As the private wholesale credit system continues to build increasingly complex synthetic structures to bypass the limits of sovereign money, the foundation of the entire global economy becomes more unstable with every passing second. For the quiet fortunes of the world, survival requires understanding these invisible gears, because when the system finally breaks, the illusion of retail safety will vanish first.